Well, it's the fourth short squeeze of the speculators on COMEX, really in the past 90 days. And I'm frustrated because I didn't catch a single one. And they've been dynamic. This most recent one, probably the most frustrating that I missed because we're heading into the December contract expirations. And a lot of that large spec and hedge fund short position in COMEX Silver was in the December contract. Well, it's not like they've got metal they can deliver. And so, I guess it was predictable that they'd have to cover, and then here they got squeezed. It was $3.10 or $3.20 in about 6 days. It was a dramatic short squeeze, and it's, like I said, the fourth one that we've had. So it's now run its course, but the best part about it, that's usually how these things turn. Elijah, I know we've talked in the past, and precious metals investors know this. A lot of times you take the stair steps up and then the escalator or the elevator down, right? And that's where you're getting hedge funds and speculators kind of accumulating long contracts, and they all rush to liquidate at the same time. Same thing has happened in reverse now over the last 6 months. The hedge funds and the speculators have gotten short and short, and there have been these periods where they all rush to cover, and you get spikes. It's just the same thing in reverse. Now, the good news is we have now put on another higher high. Price has gotten above 21 and even gotten above 22. So I am optimistic, and have been optimistic for quite a few months, that things have turned, that the lows were in. Silver, lead, gold, and the mining shares down beginning in April and May. The bottom fell out of silver faster than gold. And so the thinking on my side has been for about the last 6-8 weeks that silver would stabilize and lead things back up, and that appears to be what's happening.
It definitely does seem like that's what is happening. We've seen such a dramatic move, and this is coinciding with a huge decrease in physical supply on the registered category for the LBMA and COMEX. Your perspective on that, and do you have any updates on the extremely low levels we're seeing on both those exchanges?
Well, a couple of things. One, it's not just silver. Industrial and base metals globally at all the different major hubs are all at their lowest levels, combined lowest levels that we've seen in over a decade, if not forever. Copper and zinc and nickel and lead and aluminum and silver. And so, and again, not just in New York or London, but in Shanghai and some of the other major centers as well. So this is going to be a big story in 2023. And we've recently seen some news out of the Silver Institute, which is not necessarily my favorite research group, but nonetheless, even they've come out projecting a massive, something like 150 million ounce supply deficit for silver next year. And that's even not just mine supply, that's taking in recycling and also factoring in kind of stable investment demand. I mean, that's 150 million ounces just based on some very conservative assumptions of demand for investment and industrial use. So this drawdown in silver that you're seeing is reflective of that. The LBMA vaults, they go down 5% in September alone. And if you strip out the amount of silver held in the LBMA vaults, allegedly for the big ETFs like the SLV, then what they have left is maybe 350 million ounces. It's not very much. And then obviously there are some people on Twitter that follow the drawdowns in COMEX. Now, again, the COMEX absolute levels are still about twice what they were 5 or 6 years ago. But in terms of what's called registered, which is readily available to be delivered, has a warrant attached, all that kind of stuff, that's back down to the levels we haven't seen since 2016. So there's a lot going on in physical metal, not just silver. And that's going to be an important piece of the puzzle as the calendar flips into next year.
It is definitely a different story with respect to the story for physical silver. Now, 1,000-ounce bars are still relatively low premiums right now. But if you look at Silver Eagles, the interesting thing is here at Miles Franklin, we're now actually able to sell pre-order for 2023 Eagles. But the premiums are still extremely high. So they're, 15, 16 over spot. Silver Eagles had been as high as I believe around 18 over spot. So they've come down probably a couple bucks here, but they're still, pretty much the highest we've ever seen them. So your perspective on how even on the new year for Silver Eagles, it seems like, based on that pricing there, it seems like we're still going to see not enough Silver Eagles coming out of the U.S. Mint.
Yeah, and as you referenced, even the premiums for 1,000-ounce bars or silver grain shot, whatever you want to call it, that has all been creeping up and is reflective of this demand, not just from, the mints and the blank, manufacturers, but I mean, look at people that make solar panels and all sorts of other electronics going to need that silver and don't want to take any chances of having, some type of supply chain constraint by not being able to get their hands on it. 1,000-ounce bars aren't as high as what we're seeing for Eagles or bars or, rounds or whatever. But, there's a difference between the two. You still got to have the middleman in there that gets his hands on a 1,000-ounce bar and is able to melt them down or whatever they do, turn them into blanks, and then ship the blanks off to the U.S. Mint or the Royal Canadian Mint or wherever to create the actual Eagles or assorted other rounds. And so that shortage of Eagles will probably persist, and people want those, and that's what drives that premium. It's not that, and I'm sure you could talk to Andy about this. I mean, it's not like Andy's buying them at $22 and selling them at $37 and making a $15 profit. No, he can't buy them for anything less than $34 or $35. And so there's a shortage of them, and anytime you have a shortage, that's when you get the premium. I mean, there's great value, relatively speaking, in just regular Buffalo rounds and and kind of generic bars and things like that. There's probably I don't know if you want to call it an arbitrage opportunity, but if someone was really aggressive about it, they could probably sell their Eagles at a price up in the 30s, and then turn around and buy 25% more silver by buying more generic stuff. But that notwithstanding, it's reflective of a shortage of silver at both the wholesale and retail level, that you can't take those bars or the shot and create enough rounds that then the rounds can be shipped to the mints, and then enough supply created to meet demand. And that's where the premium comes from, and that's probably why the premium isn't going away.
It definitely isn't going away. And as you mentioned, there is that arbitrage opportunity. A lot of clients have actually done that, where they sell us back Eagles at very high premiums and then, get more silver by going to 1,000-ounce bars or rounds or just smaller bars as well. But where do you think this is leading? Because if the shortage just gets worse, then it seems like premiums just have to go higher from here. Your perspective on that?
Well, this gets back to what actually drives price. Okay, is it physical supply and demand, or is it the supply and the demand of that digital derivative, the futures contract? What we just talked about earlier about the short squeeze. Did suddenly the fundamental situation for silver change in the last 2 weeks? Or did it change in the last 2 months or the last 2 years? But in the last 2 weeks, price rockets higher by 15%. Is that driven by fundamentals, or is that driven by a massive short position in the futures market? So there does have to be physical delivery at that price that's derived by the trading of the derivatives. You can't have all of this physical demand and physical prices that are north of $30 and a paper price that's down closer to 20. That bifurcation of that market casts a massive shadow of illegitimacy on it and draws attention to the illegitimacy of it that isn't necessarily desired by those that profit from those markets. So eventually that physical demand flows through and impacts the paper price. And now you couple that with what's going to happen next year. And again, I want to I've done a couple interviews this week, and I have prefaced this every single time because I myself am sensitive to it. I don't want to have people come off and the trolls in the comments say, "Oh, okay, wait for next year. I've been waiting for next year now for 12 years and blah, blah." Look, you'll recall, Elijah, we talked about my annual forecast that comes out every January. We talked about it a lot earlier this year. And I had figured that in 2018, the Fed was forced to pivot when the 10-year note got to 3.25 and the stock market fell 20%. And I figured, well, by summertime, that'll happen and the Fed will be forced to pivot and we'll be rolling by the end of the year. Well, what has happened? Well, we blew right through 3.25% of the 10-year, went to 440, and the stock market is still down close to 20%, but at one point it's down like 25, 28%. and the Fed hasn't pivoted. So my error is just kind of thinking they'd move a little more quickly than they have, but they will. I mean, the economic slowdown signs are overwhelming. If you want to know for sure where it's going, the yield spread between the 2-year note and the 10-year note in the U.S. is inverted by 68 basis points, the most steep and steeply inverted it's been since 1979. And I'm been around long enough. I was 13 in 1979 to remember there was a terrible recession that followed from 80 to 82. So the Fed is over tightened. They will recognize that next year, just like they were slow to recognize that inflation wasn't transitory and acted too late. They'll be slow to act as they have been. They'll start cutting rates next year. Nominal yields will fall. Inflation expectations will remain sticky. We'll go to negative real rates again. You add on all of this physical shortage stuff, and we're going to have a pretty good year. I'm confident of that.